All right, good morning, ladies and gentlemen. We are ready to start our post-Memorial Day weekend trading week. Should be pretty exciting. Depends on which side of the ledger you stand at this point in the trading calendar year, bearish or bullish. I'm obviously in the bullish camp. I was in the bullish camp last year. I'll be in the bullish camp next year, so on and so forth. I had an interesting read last week from a blog written by Liz Young of SoFi. Chart right here, S&P 500 performance 225 days after the bottom. What she's referring to is the October 2022 bottom relative to the March 2009 bottom. Here's what she says. And this is what I'm gonna show you what I find interesting in just a minute. Bear with me. The mark of a durable bull market is one with broader participation in the upside. Right, and I know everybody's heard it by now. The very weak breath in the market, only a handful of stocks are carrying the markets higher, so on and so forth. I mean, the blogs are endless when it comes to this subject matter. Financial media commentary, endless. Strategist commentary, endless when it comes to this subject matter. Liz Young is the lead strategist at SoFi. Unqualified, but my opinion, right? Not trying to be mean here, but let's face it. Some of these folks that are in the positions that they are really just in the business of risk management, so to speak. With that being said, moving on. So she's looking at 225 days after the bottom from 2022 versus 2009, and what she's identifying astutely, right? So I'm giving credit where credit's due here, is that the performance differential, 225 days off the bottom, is alarming. By her view. What do we? In other words, we want to see more stocks than not pushing the index higher. Good breath is always a good thing. I agree, especially if we're trying to explain a rally with proof points around economic strength. Smaller cap stocks, typically thought of as very economically sensitive, should be climbing. Yes and no. That's not the case right now, with the top quintile by market cap outperforming the bottom quintile by 11%. Enlarging this here. Largest quintile of stocks, 17.2. Smallest quintile, 6.2. 225 days after the bottom. So what she's basically outlining is that if this rally was related to belief in the economy, we would typically see small stocks, which are economically sensitive, perform better. And they're not, at least not as well as the largest quintile of stocks in the stock market. Now, remember, she says the mark of a durable bull market is one with broader participation in the upside. As if that's the only way to describe, characterize, or reflect on durable bull markets. I'm sure many of you have heard this before, and why I asked the question. What about the signs of a durable bull market is rotation, right? Rotation from one area of the market to the other. Some are going to lag from time to time. Some are going to lead from time to time. But you get this constant rotation. That is another sign of a healthy bull market. The other thing that I want to kind of examine here in Liz Young's post as well as her chart is, why are we not using 2020 as a starting comparison, right? The 2020 bear market and recession. If we're going to use 2009 to compare how large stocks perform to small, right? The gray bar is how small caps perform to large, right? Small caps outperformed after the 2009 bottom. But why are we using the 2022 bottom if we're also talking about the economic cycle? Here we had a recession bear market. Here we had a bear market. So we're trying to use the same amount of days but we have two different economic cycles. We literally hear the very beginning of a new expansion cycle, here possibly still the latter innings of an expansion cycle that newly began in 2020. We're using two different economic cycles, and yet we're wondering, as she says here at the end, point being, although historical periods can serve only as a guide, we know with certainty that spring 2009 was the beginning of a durable bull market in the S&P, and it didn't start like this. Why? Likely because we're comparing different time frames in the economic cycle. She goes on to say, seemingly in exile right now are some of the classic cyclical sectors such as financials and energy, which is another indicator that's not exactly firing off strong economy signals. On the contrary, it's sending more late cycle, to my point. Like, she knows this intuitively, but she has different starting points for the economy here. Everyone, when people wonder why things look amiss, it's usually the individual's analysis. In this respect, she's doing it wrong. She's just doing it wrong. She has bad starting points. When you started with a bad premise, you're going to have bad outcomes. All right, this bear market looks pretty normal so far. These are all the bear markets. This was actually taken in June of last year. We were down 23.6%. But these are all bear markets without recessions. Here's the funny thing. When you look at all these examples, recessions didn't usually start for more than 2 years later. 1947, we didn't actually have a recession until 1949. 2.5 years later, after this bear market ended. 1961, 1962, we were down 28%. Bear market didn't start for several years, folks. I think till 1970. Let's see, 1976 to 1978, early 1978 bear market, near bear market. We didn't have a recession until 1980. Again, 2 years and 9 months later, almost 3 years later. 1987, we didn't have a recession until 1990. 1998 bear market, we didn't have the recession until 2001, more than 3 years later. 2011 near bear market, we didn't have a recession until 2020, 10 years later. Can the market get it wrong? Hell yeah. Heck yeah. But to my point, and kind of, enveloping this blog post by Liz Young of SoFi, she's comparing a bear market within a recession versus a bear market without a recession. All right, moving on. Some of you have seen this chart before where I use what I think are appropriate starting points, right? Equal weight. This is top chart, 2009's bottom through 2011. Exactly 28 months, equal weight relative to the cap-weighted S&P 500 index ETF finally started to underperform. Starting point for the bottom in equal weight versus the S&P 500 was in September of 2020. This is 2020 at the bottom through the current period. Wouldn't you know it? 28 months later. Equal weight broke this trend line and has been underperforming. 28 months breaks the trend line and is underperforming. Using bear markets and recessions at the same time. Bear markets with recessions. So starting dates matter. We're seeing exactly what we should be seeing. Late economic cycle market trends. All right, another way of showing, all this breath nonsense in the financial media and all these blog posts with the percent of S&P 500 stocks beating the index on a trailing 3-month basis, that it's at its worst level, meaning that basically the percent of stocks that are beating the S&P 500 are few and far between. Worst level since 2000. Now, you and I both know, you put anything out there in social media or financial media that relates or correlates with something that happened in the dot-com period, boy, are you going to get some fanfare. Here's the funny thing. We have the opposite last year. This is just from last week. Bar Charts put out this tweet from a Bloomberg article, S&P 500 index performance breadth, the lowest since 1999. The percent of outperforming stocks dropped to only 29%. Funny, when the percent of stocks were outperforming the S&P 500 to the greatest degree since, 2010, nobody cared. Nobody cared. More stocks were beating the S&P 500 last year than they had been since 2010. Did you hear anything about it? When you see charts like this, folks, make sure you give it a double take. Kind of, X out the headline and really give the chart good analysis, a fresh perspective. My perspective is, why the hell weren't we concerned when more stocks were outperforming the index last year to the greatest degree since 2010? That didn't get any fanfare at all. It's only scary stuff like this. All right. Here's the other thing. Here's another way to look at this same chart. This is the same chart down here. What happens the majority of the time? A majority of stocks underperform the S&P 500. Most stocks, right? Here's 50%. A majority above, a majority below, right? More often than not, the majority of stocks are underperforming the S&P 500. This is nothing new. It's just a matter of to what degree, right? How many stocks actually are underperforming the S&P 500? The majority of time, that's how it works. Most stocks are not going to beat the market, folks, let alone perform to the market. Here's one from Ned Davis Research, FanMag versus non-FanMag. All right, now here's the thing. Again, this goes back to the hypocrisy of social and financial media. Last year, FanMag was down 36.94%. The S&P 500 was only down 19.44%. The average stock, or the other 494 stocks, when you X FanMag, were only down 14.17%. Most stocks were beating the index last year. Most stocks were beating FanMag last year. FanMag was a disaster last year, down 37%. How markets tend to mean revert, right? This year, what's leading the market? FanMag. Things mean revert. We got terribly discounted last year in FanMag, and all of a sudden people are surprised that it's leading. It was okay when they were getting beat to crap last year. It's not okay that they mean revert and lead this year. Knowing that they basically led over the prior decade. Something's amiss, something's not amiss. This is how it works. This is how it has been working. All right, this was something that I had recognized basically at the start of May. Did you realize that the NASDAQ Composite declining bear market last year? I mean, that was the biggest bear market, bigger than COVID's bear market for the NASDAQ, and the biggest NASDAQ bear market since basically 2008. So when you see a chart or a table on Twitter or in a publication, make sure you look beyond the commentary or the headline. That was a point that was widely overlooked. This was the biggest bear market, and we didn't even have a recession since 2008. In other words, you had excess to the downside last year without a recession. Don't be surprised if you get mean reversion, excess to the upside this year in the NASDAQ. Again, look carefully at these charts, tune out the headlines. You'll probably get a fresh and probably more accurate description of what you can anticipate going forward. Let's see here. This was a tweet from last year, July 8, 2022, into the teeth of the bear market for the NASDAQ for tech. Like tech was getting demolished. But look at what the corporate insiders were doing. This is the buy-sell ratio for corporate insiders in the technology sector. Follow the insiders, folks. When it comes to buying, selling, there are a multitude of reasons, and it doesn't give the same positive signal for market performance going forward. But insider buying does. It has a tremendously positive correlation with forward S&P 500 returns. Insiders were buying last year. They knew, they understood, they were getting value, and they could wait at the very least. All right, just a month ago here, folks, this is Bank of America's Michael Hartnett. This is Barclays commentary. This is Wells Fargo's commentary. Sell the last rate hike. Still say fade 4,200. Higher unemployment equals higher credit spreads. Do we have higher unemployment? No. Actually, what we learned last month was that unemployment ticked down to the lowest level in, basically 60, 70 years. With earnings season set to ramp up significantly over the next couple of weeks, we think forward estimates are due for a reality check. How'd that work out for you, Barclays? Recession watch. We see a rough mid-2023 for equities, which appear to have looked beyond a recession that hasn't even started yet. Again, if you've been, selling, ahead of the full monthly March performance, you've greatly missed out on opportunity. What I find more often than not is that these folks on, financial media news networks, these strategists, for every, how I tend to think of it is, for every investor, there's 10 strategists, Wall Street, media outlets that are aiming to compound your opportunity risk so that you don't basically take risk at all. These folks are very good at it. Oh, this was awesome. So just the other day, David Rosenberg, otherwise or fondly known as Rosie, a noted perma bear, nobody talked about the release of real GDI today, which was part of the PCE data that came out last week. It shrunk 2.3% in Q1 after a 3.3% Q4 contraction. Averaging it out with GDP, the economy has contracted for back-to-back quarters and in 4 of the past 5. The recession has arrived and nobody's recognizing it or whatever. GDI. Nobody talked about the release of GDI today. Again, that was from last week. I love that Rosie doesn't often remember that Twitter has a search engine. And if you typed in GDI and his handle, look what you found in 2022. No debate is more useless than whether GDI or GDP had the story right in the first half. Like what? Do we found a contrarian? Did we find a contradiction? Do we have hypocrisy here? When it goes in his favor, he's more than glad to talk about GDI. When it didn't go in his favor, and as the economy was reaccelerating in the summer and fall months of last year, no, it's just a useless metric. Well done, Rosie. You the man. And you can find it all over Wall Street. Here was from, this was from last year. I would never change my mind. This is Michael Cantrell of Piper Sandler, who has a 3,200 price target on the S&P, by the way, folks, for 2023. I would never change my mind from one data point, especially when series that lead them are clear. ISM new orders are volatile. Look at the chart. There's never a straight line trend. I wouldn't get too excited about it. It's the definition of noise. That was last year when things were going bad, for the markets. Now go back to 2021. Literally, it seems to do it every September, right? I only look at new orders. Too much noise from other factors. He literally says here, new orders are noisy. Here he says, I only look at new orders. Everything else is too noisy. Well done, Michael Cantro. You the man. Kind of going back to how this year, was going to start. You basically look at how the year ended. This was something that we had delivered to our Finom group premium and contributing members. And if you're not a premium, you don't get our research. Think about subscribing to our contributor membership. You get all of our research throughout the week, every month. If you want to trade or invest with us with our guided approach, our trade alerts, our investing ideas throughout the year, subscribe to our premium membership, getting back to our regularly scheduled program. So what this chart identifies is that December 2022, so to end last year, we had the 7th month with a negative 3% or greater decline. At some point in December, like 6 prior months in 2022, we had a 3% or greater decline. That hadn't happened since the Great Depression period, folks. You have to go all the way back here. The average return the next calendar year, though, when you get this kind of dynamic in the market, 7 months with 3% or greater declines, the average return the next calendar year since World War II, after 6 months of negative 3% or greater returns, 30% return. That's the average. So 58, 75, and 2009. Bad bear markets that were followed by really strong returns. This just happened. Now, earlier this year, we had, last quarter, I should say, at the end of last quarter, we had back-to-back quarters of positive returns, back-to-back. That doesn't happen in bear markets. If you're trying to distinguish, is this a bear market rally still? Like, if you're still in that camp, you have problems. Like, go seek a psychologist, turn off CNBC, turn off Bloomberg. Let the Northman trader do his thing without you. But back-to-back positive quarterly gains does not happen in a bear market. We are now on the cusp of possibly having three consecutive quarters of positive returns in the S&P 500. The other thing to note is that the S&P 500 is greater than the 40 weekly moving average for the quarter. It's spending the majority of the time above its long-term 40 weekly moving average, basically a calendar year. By the way, that does not happen in a bear market. Also, the 200 weekly moving average is now rising. Again, that does not happen in a bear market. Don't like tech? You're your problem. Look at this. This is the technology versus the S&P 500 performance ratio. Took us quite a long time to get back to that 2000 level. But when we did, and it proved support, we have launched. Something that they say quite frequently, technicians, certified market technicians, the longer the base, the higher in space. Not in a straight line, I'm sure, but either way, you get the point. Higher for longer, right? That's the other thing we are constantly told here lately. The Fed is going to be higher for longer, and that might be a headwind for valuations for tech long duration assets. Just keep in mind, folks, the last cycle that the Fed was quote unquote higher for longer started in 1994, where they paused, lowered a little bit, but stayed higher for longer throughout the late 90s. Look at the S&P 500 going higher. This is the Fed fund rate. This is the S&P 500. Isn't it kind of ironic that today we're getting this AI boom, and back then we had the dot-com boom? Higher for longer. If that's what you're afraid of, folks, you're afraid of the wrong things. Maybe you should be afraid of commentary from strategists like Cameron Dawson, who told you, sell Sanctuary, sell tech. This was written by her. This is her blog post at the end of the quarter, first quarter. Folks, if you had sold tech, and this is what we have seen real yields fall. And they did. She's not lying. Real yields were falling. into April, but they're now all the way back to 1.58. As yields have been rising, real yields follow in hot pursuit. But her thesis was at 25 times, tech is now trading at a valuation level above its pre-pandemic peak in early 2020 when real yields were zero and on their way to negative 1% in response to the unprecedented Fed easing. This implies that tech is already pricing in a fair amount of Fed easing. If this hope for Fed easing does not materialize, we could expect renewed upward pressure on real yields and thus downward pressure on tech valuations. Again, looking at real yields, let's look at the 1-year chart. Real yields have been basically rising since the beginning of May. And tech has done nothing but go higher. Real yields have nothing to do with nothing, folks. I hate when people try to draw correlations between things that have no positive correlation coefficient. It doesn't. There's no relationship between tech, long duration assets, and rising yields or falling yields. There's just not. But people look for excuses right, left, front, and center. Don't get me wrong. Again, I'm not trying to, call out. I'm not trying to denigrate these strategists. It just is what it is. They're risk managers at heart. I'm not mad. I'm not saying anything bad about them. It is what it is. Quite frankly, I don't think this is their last rodeo or our last rodeo as investors with them. Kind of reminds me of this song. Sheets with your fingertips. Last bottle of Jack, we split a fifth. Just talking about life, going sip to sip. Yeah, you know it'll be fine. And I say shit I don't, but I'm still gonna wake up on you and me. I know that last night we lit the top. This ain't our last night with these strategists, folks. They'll be back, and so will we. Tune in next time to Finom Group's latest video. Take care. Have a great trading week, everybody.